Welcome to Scalpers University, Module 1, Psychology. Psychology is the single most important factor in any trader's career. If you can master your psychology, all aspects, and all the psychological concepts related to markets, both internal and external, so not just your own, but also of the market itself, you will set the foundation to become a profitable trader. This holds rank above all else, and obviously is why it is module number 1. So before you think about any tactics or think about breaking down into technical analysis or anything like that, you need to first step back and view things from a higher level. We're going to be looking at psychology and the crypto markets. So this is a high-level overview of the fundamental truths about markets, how they interact with each other, how you can interface with them, and how you can apply the concepts within to become a better trader. So this is how I view trading personally. These are the 5 fundamental building blocks of a profitable trader, and they must be followed in order. So you must hold preference or rank of them from top to bottom. Do your best to hold these in that order while you trade, especially so while you're learning. And it's one of the biggest mistakes I see for unprofitable traders and new traders who never make it is they get the order, they get the order of their learning and the order of their system or strategy the wrong way around. So the one you'll see at the bottom there, tactics, is pretty much exactly where everybody starts whenever it should be the last thing that they do. So most people get dragged into trading with the promise of some indicator or some magical chart pattern or some wild theory by a Wyckoff or someone like that, or an Elliott wave, all that kind of shit. And they come in thinking that is the market, that the market is this, there's some predictive power to these patterns and these indicators, when they're missing the most fundamental building blocks to actually allow them to be a profitable trader. So what you need to first do is step back and view everything through the lens of the meta. Okay, so essentially trading is a game. I believe trading is a game above all else. It's a commonly shared belief within the market. It is essentially, that is a truth. That is a truth within the market. You have opponents on one side. It is for you to win, somebody else must lose. So it is in that sense a player versus player game. Like any game, there's a set of fundamental rules or truths that guide it, and this is what you would call the meta. So meta, just if you're not aware of what meta means, meta just refers to the highest order of thinking. Some people may have also heard of this as the term first principles. I use these interchangeably. First principles is about boiling something down to, breaking a complex topic down into the very fundamental truths that underlie it, the foundational propositions, the assumptions that cannot be broken down any further. So that's a very scientific term, first principles. It's, if you've done engineering, you'll recognize it. And essentially the meta is, to me, I view them as the same, whereas the meta is the overarching view, the highest order of thinking. If you've heard of things like metacognition is where the concept of thinking about one's thinking, so being able to view your own thoughts, view your own understanding and performance, or metaphysics, which is a philosophical field that studies, the nature of consciousness, causality, space and time. Again, these very, very, very fundamental truths, the fundamental building blocks, or the fundamental building blocks of ourselves in terms of metacognition. And so what we're looking at with meta is the fundamental building blocks of the market for us as traders. If you're a gamer, you play poker, you play chess, you'll understand meta in terms of, the generally agreed upon strategy by the people who play that game. It's the most optimal way to win or to have the best performance in that game. All that would be to say that meta is first principles. If you're a first principle thinker, you will do well in trading just by default. If you have background within engineering or computer science and something like that involves that type of analytical thinking, it sets you up to be a better trader. Now, it doesn't get you out of the way of your own flaws as human, your cognitive biases, your emotional defaults and defects, but it's certainly a good place to start, which is why it's top of the list. That's the one we're going to be digging into today, and we're going to go through what I view as my 5 fundamental truths. So my first principles of the market and of markets in general. So my list isn't exhaustive. Work on your own. Don't just take what I show and treat it as gospel. None of the 5 topics I'm going to talk about can be disputed. They are all fundamental truths, but there are more things about markets and about the market and crypto markets in general. There are more things that are truths as well. I haven't included them here. It would be too long of a presentation. The purpose of this is not just to parrot me. Go and look and view and study and think yourself about other fundamental truths and how you can use them to guide yourself. The whole point of this is not for when everything's going well. It's really for when things are going poorly, or if you're just a little bit out of line. So if you're struggling in your trading, whether that's at the start or whether you're very experienced, referring back to first principles is always the best way to, ground yourself and come back to a level where you can then figure things out and move forward. All right, it's very easy whenever money's on the line and when you're trading and you're on a streak of losses. It's very easy to get stuck inside your head and to be thinking that the market is this, game on a screen and it's clicking buttons and it's, it becomes very binary. You get a very messed up view of it where it's like, you're not just playing a slot machine. But just remember that if things are not going well, pull back, take a step back, view things from the lens of first principles. And I guarantee you'll be a much more profitable and emotionally strong trader. So rule number 1, conviction moves markets. If we're thinking from a base of first principles, what is a market? Well, every market is simply a collection of individuals, every one of whom is acting in their own self-interest, and they all want to profit from the future price movement of said market. And then as a result, they create the movement as an expression of their own beliefs about the future. Okay, so you put yourself in those shoes. You go into the market acting in your own self-interest, yes? You go in to make money. And if you're a buyer, because you think the price is going to go up, whether it's a very, very small part, if you're just a super low stakes trader, or if you're a massive 10-figure, 11-figure whale, you are creating that movement yourself. Now, as a small trader, as a fish, as you would be called, where you're starting out and you're, super low stakes, or you're not someone who's materially impacting the market, it's actually a harder concept to grasp than when you are a larger participant. And this is one of the reasons as well why it's like, the old saying that the rich get richer. And that's because they have a couple of things. An abundance mindset would be one, but also because once you've done something, you know how to do it. Once you've seen it and done it, this is a similar thing where the conviction side and the conviction of moving markets, once you're actually able to move markets, it's much easier to believe that and to truly onboard that into your subconscious. You know that you have self-interest in the market and you want to profit from the future price movement, but you might not think that you're the one who's actually creating that market to move, because you might buy Bitcoin today and it might go down. So then it's easy to say to yourself, well, I didn't create any movement in the market today. I bought it and went against me. That's not actually true. The only difference is your buy was just filling somebody else's sell order, and that seller and the collection of sellers that you were buying into had more aggression overall and essentially had a stronger hand, so the market went down. So you did create the market to move, and just because the market didn't move in your favor does not mean that you didn't make it move. You played your part. If you've ever traded a market, especially say a fairly illiquid altcoin, you'll have seen times where you have physically moved the market. If you go onto a 1-minute chart or a 5-minute chart, you'll be able to go back and see, that was me, that was my candle. Even a 5k market order can push price up by a couple of percent. That's the way you want to think of it. Every trade shares the same fundamental parts. There's a buyer and a seller. There's a maker and a taker. All right. So takers, who are active participants or dynamic participants that you'll hear me referring to them as, or aggressive, they move the market. Takers have conviction. And this is the only thing that moves a market. Okay, I'll repeat that. The only thing that can move a market is the aggression of a taker and the conviction of a taker. All right, and then on the other side, you've got a maker, which is the person who advertises the order. Okay, so that's where the term market maker comes from. They typically are the ones who provide liquidity. So whenever nobody else is there to provide liquidity, a market maker's job is to do that. And so you've got the maker, also known as the passive participant, also known as a limit order. Okay, so you put a limit order on the books, that's passive because it doesn't execute straight away. It's just sitting there waiting passively. And then you have the taker who comes along actively, aggressively, dynamically, and they come into the market and say, I want to buy now at whatever the price is, and they place an order. And depending on the size of their order, that will get filled by going through the books, so through those passive orders of the market, of the makers, until it's fully filled. The fundamental truth is that only conviction can move markets. Then you have to boil it back down again to, what is the purpose of trading? What are you taught? What are you told? And what is the belief that everybody has in trading? The most commonly held phrase or commonly parroted phrase in trading, which is true, is buy low, sell high. Yes? You want to buy low, you want to sell high. You want to sell high, you want to buy it back low. How do you buy low? There is only one way to actually buy low, as in the price, say Bitcoin is 50k now, and you want to buy it at 48k. Can you buy that with a market order? No, because if you put a market order in at 50k, it's going to execute at 50k. If it's 50k and you want to buy it low, you want to buy it at 48, you have to put a limit order in, okay? Which makes you then a passive participant. And similarly, if it's at 50k and you want to sell it at 52, you have to put a limit order in to sell it. You have to again be passive and you have to wait for the market to come to you. So when I say that conviction moves markets, that's exactly why, or that's exactly what it means to move price. So if you've got a maker if you're there waiting to buy Bitcoin at 48, somebody has to push the price down into you. Okay, so it has to be takers who come along selling at the market to push the price down through the books, to eat up all those buy orders on the way down and go through all of them and get to 48k where you're resting and you're waiting to buy. That goes completely against the basic rule that I just said: buy low, sell high. Why would somebody sell low or buy high? Because that's what you're doing essentially, isn't it? Price is 50 and you're putting a sell market order in and it's pushing the price down towards 48. You're actually selling low because your aggression is moving the markets. Okay, so imagine yourself as a whale who's trading 10 figures, and when you sell 500 BTC, it moves the market down $1,500. Why would you do that? Aren't you just costing yourself money? Well, the only reason you would do that is because you've got conviction that you can buy it back lower. Yes? So that should be starting to make sense. You can sell low as long as you buy it back lower. And so that's when the aggression of a taker can be a profitable thing for them. So the best example would be, let's say, a liquidity run or a liquidation cascade. If you know with a high degree of probability that Bitcoin's at 50k, let's say there's 600 BTC on the books between 50k and 48k, you know then that if you sold 800 BTC at the market, that it would tear down right through all of that liquidity below 48. You knew that there was going to be a lot of stop losses of retail traders there. You could estimate and expect, okay, if I can get it to 48, then it's going to trigger a cascade of chain liquidations, stop losses, and it's going to push price down even further because they become orders at the market as they're unwilling sellers. And that would maybe move price down a bit further to, let's say, 46, 45, where you get one of those long wicks. And then I'll fill my own buy orders there. All right, so that's where the conviction side of it comes from. That's why you're willing to sell low, what you would consider to be low, sell at 50, push the price all the way down to 48, cause some slippage, lose a little bit of money on the front end. But then, if you get the desired outcome, it'll push price on down and you'll start that momentum that will eventually push price down to 45, where you can fill your 800 BTC back, plus an extra bit, let's say. And then suddenly, you've spent a little money, but now you're straight away making money. That happens at all time frames. Conviction will always move them. So the only reason that there would be anybody putting a market order in willingly is that they have conviction the price is going to go higher or that it's going to go lower. I'm sure there's times that you've bought using a market order. So just put yourself in your shoes then. So go back, think about that time. I try to use limit orders as much as possible, but sometimes you have to use a market order. You simply have to get filled. Well, you placed it at the market because you believed that the market, let's say it was a buy order, you were going long. You placed it at the market because you believed that the price was going to keep going up, yeah? You didn't believe price was going to come down. If you believed the price was going to come down even $1 from that price, you would have placed a limit order at $1 below the price. So what is that? That's conviction. You had conviction that the market was going to keep going up, so you placed a market order. Now, not here to say whether that conviction was accurate or not. You might have been completely wrong to think that, but you had conviction. Conviction doesn't have to be accurate. It doesn't have to be directionally accurate. It doesn't have to be right. It just has to be a strongly held belief that the market's going to move in a certain direction. Rule number 2, the market is always right. On the face of it, it's quite obvious, of course, but I'm sure you all know as well, if you've got any experience trading, how often it feels as if that's not the case. That your ego will get in the way and your ego will tell you that no, the market is wrong. That's a bit of a meme and a joke that people make, but we all know it, we all feel it, that when a trade that just looked absolutely perfect setup, you've seen it play out a million times before, and it always comes out good, and it goes against you, you think, fucking damn, the market's wrong, and you start looking for reasons why the market's wrong. The current price that we're at represents the consensus belief about value of all the traders who are in the market at the moment. When there's two traders, one wants to buy, one wants to sell, and then they execute that, they've made the trade, and that's what makes the market. It doesn't matter if you had a perfect, falling wedge pattern that didn't play out. That doesn't mean that the market was wrong. It means that you were allowing yourself to think that the market is anything other than a collection of buyers and sellers. Okay? The only thing that matters is at that moment, is there going to be a buyer and a seller agreeing on a price? And who's going to be more aggressive? Who's going to be the maker? Who's going to be the taker? Are you going to have a falling wedge that's sitting perfectly at the breakout point and you're going to go long? And is a whale going to come in and dump 1,000 BTC and push the market down another 2%? The market is always right. So really ingrain that one in your head. And again, this is why you're probably starting to see that these first principles, these foundational truths, are good to come back to whenever things are not necessarily going as well as you want them to. It's a game of chance essentially at the end of the day. And if you can come back and remember, no wait, the market is always right, because barring, an exchange malfunction, which happens very, very rarely, the odd occasion something will break, and maybe very briefly the market might be a bit out of whack. But just on a normal day and a normal trade, which is 99.999% of your trades, whatever happened was meant to happen and did not happen by accident. The market was right. Rule number 3. Markets remain in perpetual motion. Perpetual means never ending. Okay, as you can see the image there, the infinity loop. That's all it means. Perpetual means never ending, continuous. A lot of you, as your traders, you'll trade perpetual futures. And you should know that a perpetual future never expires. That's why it's called perpetual. If you trade dated futures, they expire on a certain date whenever the trade gets settled. Not just crypto, Bitcoin, but every market exists in such a way that from a psychological perspective, there's not a beginning and there's not an ending. Okay, so the markets do not begin, they do not end. And if you've traded, or if you know about traditional stock exchange or traditional markets, you might think that's not true. You might say to me that, well, what about the open? There's New York Open, there's New York Stock Exchange opens at 9:30 and it closes at 4, and they close at the weekends and they open on a Sunday night. Of course, in crypto, the market truly does never close. But the point is not about the ticks on the chart. It's not about the candles. The fundamental truth is that the game of trading begins and ends only when you decide to enter and exit a trade. It does not matter about market opening and market closing. The market is always moving. It's always affecting people. It's always affecting emotion. It's always causing mental energy to be spent. Let's step away from crypto, because it is a 24/7, 365 market, and let's go and say gold or oil, okay? A couple of boomer markets. If you're trading and you're in a trade on gold or oil, and the market closes Friday evening, and you're still in your trade, so Friday evening at 9 p.m, whatever time the futures market closes, is that trade over? Has the market stopped? So anyone who's held a trade over weekend on a closed market will know that no, it isn't. The trade is not over. Because if it's still occupying space within your mind, the trade is still very much alive. If you're in that trade at 9 p.m. on a Friday evening, you're still going to be thinking about it until whatever time, 9 a.m. on Monday morning when the market reopens. And whenever you're not entering and exiting, it's doing that for millions and billions of other participants across the world. So it never ends. It's always going. The market's always moving. It might seem a little bit arbitrary. That is to help you as a scalper or a day trader. It's to help you to step back and realize that there's never any rush to take a trade. There's always another trade that's going to present itself, and that there are literally an infinite number of options. So remember that the markets remain in perpetual motion. It's up to you to decide when you enter and exit the game, and be very careful with that to not always end up in perpetual motion yourself, because then you're going to be 24/7 in a trade, and you're going to be constantly thinking about the charts, and it's going to destroy your life. Get in, get rich, get out. Rule number 4. News does not move markets. Amateur traders believe that if they can figure out the reasons why the market did what it did, these reasons will somehow help them to determine what the market will do next. Common one, Bitcoin crashed because China bans crypto again. That's one of the most commonly parroted, misinterpretations within crypto. Everybody thinks, and they will swear to you, that the markets crash because China banned crypto. That is not true. Now, yes, when a FUD news piece about China banning crypto gets released, the market typically goes down, but the markets did not go down because China banned crypto. The markets went down because the conviction of the sellers outweighed the conviction of the buyers. So back to fundamental rule number 1. Conviction moves markets. Traders move markets. Okay? Now the conviction of the bears might have become stronger because of that news, but it was still just conviction. It was not the news itself. The crypto China thing has always moved the market down traditionally, but let's flip it around. How many times have you seen news that was considered to be bearish, in air quotes, such as a high CPI print, which would indicate that inflation is rampant. High inflation is not bullish for asset prices, for risk asset prices. And so you get this print of high CPI, very high inflation, and yet the markets such as the S&P 500 and Bitcoin, they pump on release of this news. S&P hits new all-time high, even though the inflation figure is nearly 7%. Doesn't that completely invalidate the news? Why would negative news cause the market to go up? Again, because of rule number 1. Conviction moves markets, and traders move markets. All right, it's a game at the end of the day, and we'll go much deeper into game theory in the next module. But what you saw in that second example was pure game theory. It's bad. Inflation. They're going to raise interest rates. It's going to be bad for asset prices. They're going to taper. They're going to stop purchasing assets. They're going to stop printing money, and so everyone's bearish all week, waiting for this inflation print. And then what happens? They release the news. Everyone thinks, oh shit, this is super bearish. They sell, and the conviction of the bulls, who realize that everybody else has been getting themselves all bearish and getting short, they realize that, oh wait, there's gaps in the book to the upside. I can just tear through this book and start buying aggressively and cause a chain of liquidations up higher and squeeze people. So that's really what's happening, is the conviction. The conviction of those bulls or market makers or whales, whoever it was greater than the conviction of the panic sellers. So it's not the news that moves the market. It's the traders that move the market. Most traders act on impulse, and then in hindsight they apply a rationale for the behavior. So this is very common, especially with men. So you nail a really good trade. You want to then go back and detail it and break it down and say, here's why this trade went well. I bought because we had a sweep of the lows and we were at 30 on the RSI, and we put in a bullish candlestick pattern, and I bought, and then it exploded up and I made profit and I closed my long. Great trade. And you journal it and you pat yourself on the back. Everything you just described is just hindsight, justifications for what you did well. And even more so is whenever things don't go well, the excuses come out. And that's typically when it's news related. Whenever you do well as a trader, you want to say it was because of your superior analysis tools or your edge. But whenever you do something bad, when you fuck up, when you get a bad trade, when you get liquidated, when you get stopped out, it was, fucking China, China banned crypto again. Or Elon Musk tweeted about such and such. All right, there's always an excuse. And everyone's guilty of this. I've been guilty of it. You all have been guilty of it. Everybody wants to search for meaning for both winning and losing trades. But eventually you will transcend beyond that and realize that that is not what the market is. There is news, yes, but it's only the reaction to that news in terms of the conviction of buyers and sellers within the market. That is all that matters. And you can never know what that conviction is going to be unless you are at the level where you can affect markets yourself and move markets. And I'm going to assume that nobody here can do that yet. That's where you're hopefully going to get to someday. That's the goal for all of us. But for now, you don't know. And there's an entire industry built upon this fucking hindsight analysis. News articles, paid newsletters from these professional market analysts, in air quotes, and just a bunch of grifters who'll post a 20 tweet thread on Twitter, or they'll post a new article in Cointelegraph 6 days after the Bitcoin crash, breaking down exactly why it crashed, with all their fancy charts and on-chain data and their technical indicators and their fear and greed was overheated and their funding was over, blah, blah, blah. It's all just bullshit hindsight analysis. Hindsight does not help you predict the future. Men in particular love to overanalyze and search for meaning. It's kind of fundamental to our nature. And that's why there's more men who are engineers and everything like that. We're problem solvers. You think. In trading, you need to kind of get that out of your head. News does not move markets, okay? And to extend on that, neither does your technical analysis. Your technical analysis does not move markets. We'll get much deeper into that later. But your indicator doesn't move markets. Big mistake I see is a trader who believes that because his indicator has a hit rate of 70%, he thinks that that indicator is predictive. It isn't. Nothing predicts the market. You cannot predict the market. It is 100% random. So even though there's been a really high-performing strategy or system or indicator, it is not guaranteed even for one more trade. That's why you hear of alpha decay, where you have an edge or a system or a strategy that works, and over time, the effectiveness of that diminishes. So don't overanalyze, don't search for meaning in things. So just stick to your first principle and remember the only thing that moves markets is conviction. Rule number 5, my final rule. Markets are random and infinite. People relate poker and chess to trading, and they are very good comparisons, but they're not perfect. Chess and poker both have a set of rules and a limited number of possible outcomes. They are finite games. They're still finite games. There is a very defined number of plays, of cards that can turn over, of moves you can make on a board, and at the end of the day it all comes down to probabilities and math. Financial markets, on the other hand, they don't have any rules and they are infinite. The outcome is truly random. As much as people will, they might espouse the fact that markets are rigged or they're manipulated, there's no possible way for the market to be totally controlled by any one entity. Okay, in any free market. There are levels of manipulation. There are levels of being rigged or controlled. Crypto is the most free market that there has ever been. If you trade the S&P, you ever have, the S&P 500, they will put circuit breakers in if it drops too much or if it goes up too much. They will literally halt trading back to a previous point, which was about, let's say, patterns and past performance not predicting the future. So you got Group A and Group B. Okay, we've got a group of whales, two groups of whales, Group A and Group B. All right, so Group A of whales in Bitcoin are bearish. All right, and they spot the chance to liquidate retail traders on thin books. Okay, so there's low liquidity on the books. Bitcoin's at, whatever price it's at, 50k, and they calculate it will take just 800 BTC to push price down 3% and cause a chain of liquidations, which will push price down even further, which will then allow them to fill their own buy orders much lower. All right, so they push price way down, fill their orders lower. Typical, whale games. They did this 6 months ago. Very similar setup. Same group of whales. They spotted it and they said, okay, now we've got this similar type of setup. We're at a key level. We've got thin books. It's only going to take 800 BTC to push it down. Let's go. We did this before. It's going to work again. Let's do it. And they go, bang, ready to push the button. Then all of a sudden, whale group B comes in. 1,000 BTC buy wall pops up from another group, bullish whales, and they want to defend the price. And all of a sudden, between 50 and 49,500, there's a wall of 1,000 BTC. So even though there was an exact setup, the same exact setup that Whale Group A used 6 months ago to pull off a successful stop run, you cannot account for the heavy-handed foe stepping in. It is random. The bull flag. Let's say a bull flag comes up on the 1 hour chart, and last time you saw a bull flag on the 1 hour chart, well, it broke out and went up another 6%. So you buy, and then it goes down. Past movement of the price in any form, whether that's dollar to dollar or in candlestick pattern format or anything, indicators, RSI, whatever they did in the past does not predict what they will do in the future. The market is random. There are new people coming in and out of the market all the time. There are people who trade on a whim all the time. There's people with way deeper pockets than you that come in and decide to just fucking wreck the chart for whatever reason. And you can't control any of that. So in an infinite and random market, it's essential that you establish rules to guide your behavior. All right, so you need to create a definition and give yourself the direction within the market. Otherwise, you'll get overwhelmed super fast. Right, so you'll have too many possibilities because, again, like I said, it's infinite. There are actually an infinite number of ways to win and an infinite number of ways for you to fuck yourself up and get liquidated. And most people tend towards the second option. That's just, again, human nature when you involve money. And we'll dig deep in a later module into how to build a system, build a set of rules. I know guys, personally, I know scalpers who only trade the New York Open for 1 hour a day. I know one guy who only trades once a week on the CME Open. And he comes in, trades that, because he's done it so many times. He's got a super high hit rate with it. He can get 80%, 85% hit rate. He doesn't come in and just go long or go short arbitrarily. He watches how it opens and how it reacts, and he knows with a fair degree, a fairly high degree of probability what way it's going to move, because he knows how the certain participants who trade the CME Open act. Infinite numbers. Some people trade the 1 minute chart, the 1 hour chart, the 15 minute chart, the 1 week chart, the 1 day chart. Some people trade RSI oversold, overbought. Some people trade on balance volume. Some people trade MACD. Some people trade blah, 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 blah. It could go on forever. It is literally infinite. So anytime you get overwhelmed, when you have a bad trade or a bad series of trades, come back and just say, oh, yes, my guiding principle, remember, markets are random. They're infinite. I do not need to be trading every tick. I do not need to be overanalyzing and jumping into another trade just because I lost one. I just need to remember that the market's going to do what it's going to do. I have no control over it, but I can, over time, build a system and learn and understand enough that I can be right more often than I'm wrong, and then I can make money. All right? So that's the end of this module. Next, we're going to go one layer deeper and actually begin to rewire your brain for trading success. So we're going to take it from the high level and bring it down a level into your own interface with the market.